A jump in US bond yields and the US dollar has been the story of the week in financial markets. It seems that the rise in the US 10-year Treasury note yield that began in mid-April was the start of something big, or at least big enough to loom over markets for some weeks. The poor performance of the US dollar in December and January, even as US interest rates headed sharply higher, was the cause of much debate. This debate will surely continue, but it does seem that the US dollar rally over the past week could be more than a blip. The breadth of the move is impressive, with all major currencies falling against the dollar over the past week and many emerging market currencies sharply lower as well. The 10-year US Treasury note yield's long-awaited break of 3% for the first time since January 2014 isn't simply due to increased investor concern over widening US budget deficits. There has been a sizable move in market pricing for Fed tightening, with the implied yield for July 2019 up 15 basis points since early April. Markets now price in a little more than 3 rate hikes by mid-2019. So by that time, America's benchmark interest rate could be around 2.5%, while Australia could remain on 1.5%, and the likes of Eurozone and Japan should remain closer to 0 than to 1%. What's not so clear is whether there was a particular catalyst for this increased confidence in ongoing Fed tightening. One positive is that trade tensions have slipped from the headlines as progress is made on NAFTA negotiations, and the US's final decision on tariffs on Chinese imports is not due until late May. Perhaps with a tight US labour market taken as given, the market focus in terms of the Fed's interest rate decisions is more on the balance of risks on inflation. Crude oil prices this week reached highs since late 2014. At the very least, this will support headline inflation rates around the world. In Australia, inflation in the first quarter was 1.9%, close to market expectations. This won't have surprised the Reserve Bank, whose board meeting is on Tuesday. The RBA has made clear it isn't considering moving its cash rate from 1.5% near term, so markets will instead focus on the statement. In particular, we'll be keen to see whether Governor Lowe will indicate that the RBA is cutting its 2018 GDP forecast. These forecasts are in the quarterly statement of monetary policy on Friday, the 4th of May. We expect the RBA to lower its growth forecast from 3.25% to 3%. This is still above Westpac's forecast of 2.7%. The global focus will, of course, be on the Federal Reserve's policy decision on Wednesday. Having raised rates in March, markets expect the Fed to pause at this meeting before hiking the funds rate in June. If the Fed statement remains upbeat, then the US dollar should extend its recent rally. This suggests that the Aussie dollar could remain under pressure from the rebounding US dollar, probing and perhaps breaking December's lows around 75 cents. We'll speak to you next week.